Hi friends, let me start this video with a simple question. Who has the best view of a particular stock? Is it the rating agencies? Is it the media channels? Is it the YouTubers? Is it the DIs? Is it the FIs? Or is it the promoters? Simple answer will be that Rahul, promoters have the best view of a particular stock. So when promoters are selling stakes in their own company, what does it tell you? Three possible reasons. Number one is that either promoters think that the valuations are very high. Right? Possible. Secondly, they may think that the company is likely to face a slowdown or a headwind in the near future and therefore they're exiting the stock. Third possibility could be that they're also booking profits because they're also investors like you and me, and therefore time and again they might book some profits. But irrespective, when a promoter is selling the stake in the company, you really need to be cautious. Can I give you an example here? Have a look at my screen, and what you will see is that between Jan 2023 and July 2024, Nifty was in a massive bull run, 37% gain at Nifty level. Now you can go and check the individual stocks. You might find that the stocks were up by 80%, 100%, 200%, so on and so forth. Now what happened during that period? If I show you some data, you will note that promoter selling at that time was at peak because it was highest in last 5 years. And if I do some maths, the total promoter selling was $10 billion plus $12.4 billion in the 18 months of period. Huge selling by promoters because possibly they found valuations to be very high and they have the best view of their company's stock in terms of the business prospects as well as valuations. Now coming back to the theme of this video, which is what happens if a promoter is buying their own company's stake. That definitely tells you or signals you that the company is likely to see bright future and therefore promoters are accumulating at this particular price point. However, that does not mean that we go and blindly invest in that particular company. We have to still look at the fundamentals of the company and make our own decisions. So in this video, what I'm going to do is I'm going to present you commentary on 3 stocks where the promoters have been recently buying the stakes in the company. Again, these are not recommendations here, but these 3 stocks will serve very good examples for you in terms of how to go about studying the businesses where the promoters are buying their own stakes. Please do not take these as recommendations. With that, let's get this video cracking. So the first stock that I'm going to speak about is KPI Green Energy. Have a look at my screen and you will see that very recently in the month of May, literally 2 to 3 days back, their promoter and director Farooq Bhai, Gulam Bhai Patel had done buying in his own company. In fact, not just in the month of May, March, February also, he's done some buying. So there is a continuous buying pattern by the promoter and director of the company. We really need to dig deeper in terms of what is really happening in this business. So let me present to you totally unbiased commentary about this particular company and bring you the latest and greatest about this company. If you look at this company's profit and loss account statement, that is a very good starting point. What you will note is that the company is sitting at all-time high revenues of 1735 crores as of March 2025, and the PAT has been around 325 crores, again all-time high as of March 2025. If you look at the past track record, very quickly you will note that the sales growth has been compounding at 97% in the last 5 years. Profit growth has been compounding even more at 118%. Even trailing 12-month results, if you see, has been fantastic results, very strong results that we can see. 69% growth in the sales, 99% growth in the profits in the trailing 12-month. However, as smart investors, we also need to dig deeper and have a look at my screen. What you will note here is something interesting. PAT margin. I want you to focus on PAT margin. In FY24, their PAT margin was around 15.7%. In FY25, it has gone up to 18.5%. So 3% PAT margin improvement. What does it tell you? That the company has become operationally more efficient in FY25 because they are able to generate better PAT margins. This is very important point because what it tells you is that company is becoming operationally better where it was previously. Now there could be many reasons. For example, here if you look at the debt to equity, because KPI Green Energy is a small cap stock, you always need to look at the debt, and this being into the power sector, it makes 100% sense to look at what is happening with the debt to equity ratio. In FY24, the debt to equity ratio was 0.49. It has in fact come down to 0.33. Albeit the debt has gone up. So debt has gone up from 417 crore to almost 862 crores. So a lot of investors will get worried when they see, oh, debt is going up. But you have to look at in the context of debt to equity ratio, and that has come down. Possibly this may be one of the reasons that there is an operating leverage here. Again, we need to look at from various angles and find out what is really going on in this particular company. Now we need to also understand the business model of the company, because we need to really evaluate the company on what is the future prospect of this company. So for example, here the company operates into two segments. Number one is independent power producer, which is IPP, simply meaning that they produce power, and anybody in the world wants that power, they can come and buy it from KPI Green Energy, right? 13% of their business right now is coming from IPP. I'll talk about that in a bit, but if I focus on CPP, which is the captive power producer, simply meaning that, let's say for example, Unilever is setting up a plant and they need electricity to run that plant. They have two options. What they can do is they can set up their own power plant, or secondly, they can go and ask KPI Green to say, hey, can you come and set up a power plant for us, because we want to go renewable energy, for example, wind or solar, whatever that could be. That is the captive power producer in this context, and 87% of this company's revenue are coming from CPP. Now here is the fun part that you need to know. If you look at the company's comments about the EBITDA margin from IPP as well as CPP, interesting point is that IPP delivers them around 85 to 90% EBITDA margin. This is a huge EBITDA margin. Okay. If you look at CPP, that is bringing around 20 to 22% EBITDA margin. Now the company's goal is to take this 13% of revenue to around 25% in the near term. Again, they haven't really given a timeline, but if they are able to do this, what is likely to happen is that their EBITDA margin are likely to potentially improve further. And that is what we saw in the PAT margin improvement, because possibly the IPP market share is growing up in their revenue, and therefore the EBITDA margins are improving. PAT margin will naturally improve. This is what I can see right now is one of the positive points coming from the management's commentary. Now the second positive point I think about this company is potentially if you look at the upcoming orders. So for example, here IPP wise, their current capacity is at 503 plus megawatt. It is likely to become 1.20 plus gigawatt, which is almost 2.5 times of the growth. And if you look at the CPP, again, very similar story, from 447 MW, which is megawatts, to 1.76 gigawatt. So in the next 1 to 2 years, this is the timeline the management has given, the company's capacity is likely to go almost 2.5 times. Company is in fact putting around 4,000 crores of capex, and they are going to take this IPP to 1.5, which will be in phase manner. But hopefully in the next couple of years, they might achieve this new upcoming capacity. And on the basis of this upcoming capacity, the company is saying that we are likely to grow at around 60 to 70% growth year on year in the next couple of years. That's what the company's commitment is. Now, whether they're going to execute it or not, we don't know the future, but that's where the company is heading towards. Now, here is even more interesting point that I was reading through their con call script. What you note here is that the company is saying that there are also new orders, and he's saying that we cannot disclose them right now. And this is where I think that when a promoter is buying their own company's stake and they are not disclosing some information because of various reasons, maybe competition or maybe something that has not been finalized in terms of the order. But what the management is saying is that within the next 6 months or the next quarter, you are likely to see a substantial increase in the order book, which is going to cover the entire FY27. So the order book they are going to build in the next 6 months is likely to cover the revenues that might come for FY27 as well. So all in all, what you see here is that the company's future growth, near-term future growth, is looking very positive. Is there any negative point about this company? Yes, there is one red flag I can see right now with the company, and that is that almost 45% of promoter stake they have pledged. Pledging is never good for a company. The promoters here have pledged around 45% of their stakes in the company. That is a big red flag that you need to know. Also, secondly, their order book execution, we do not know whether they are going to execute that or not. Again, on quarter to quarter basis, the results will come out in the next 2 to 3 years. And depending on how they perform on a quarter to quarter basis, the stock prices may move. But hopefully this commentary has given you a lot of meat about this particular company. What I would highly recommend you to do is that go and read about this company a bit more, make your own analysis, do your own research, and accordingly you take your investment bets. This is not an investment recommendation sort of a video. I only try to give you salient points so that you understand how to go about analyzing various companies. And if you like this, request you to hit the like button. Let me know in the comments a simple thank you. And finally, if you want to practice practically learn how to go about analyzing various assets, you can consider joining my YouTube community. Almost on a daily basis, I am posting on the community about various assets. You are going to learn practically. The feedback has been excellent. This is the only way I teach people. I do not have any courses. I do not have any WhatsApp, Telegram channels. This is the only way I teach people practically. Go to my channel, find the join button and be my guest. With that, let's get to stock number 2 now. The second stock is also a small cap stock from construction sector. Have a look at my screen. The name of the stock is Suntech Realty, and what you will note very quickly is that in the last few months, in the month of May, March, February, the promoters, in fact, different promoters have been buying the stakes in their own company at different price points. You can see it here. Again, I don't know what is the price right now when you're watching this video, but this was the price at which these promoters have started accumulating this stock back in the last 3 months. And one of the last transactions, if I go and look at exchange, what you will note is that this transaction is done using open market. This is an important point you need to understand, because whenever a promoter is buying their own stake from the company and it is done through open market, that is a very, very good signal. Why? Because sometimes promoters may also buy their own company's stake using a block deal, and that may happen because whenever a big investor in a particular company is exiting the stake from the company, for example BAT, right, that is exiting from ITC very, very gradually and slowly, and what happens typically is that the prices may fall because a big investor is selling the stake, and therefore promoters have to step up to be able to protect the stock price, and they buy the stakes using block deals. So there the thesis is that the promoters want to protect the stock price and therefore they're buying the stake. But in this example of open market, here there is no danger of existing investor exiting and therefore they have to protect the price. They're simply buying it through open market. I hope this point is very, very clear to you. Now let's dig deeper into the company's fundamentals. See, the first point you will note about this company is that if you go back to 2016 and have a look at the chart of this company, you will note that it has been a very, very cyclic company. These are all monthly candles here because I wanted you to have a look at the last 8 to 10 years of pattern, and very quickly we note that this has been a very, very cyclic company. Now, why has this been cyclic company? Simple answer you will find if you go to the P&L statement of this company. What you will note here is that inconsistent top line and very inconsistent bottom line. And in fact, this is one of the very negative of this company, because I am going to give you unbiased commentary about this stock. I will have to give you negatives, positives and everything in between. So what you see here is that, for example, in the year 16, revenue was only 243 crore. Next year it went almost 4 times, 952 crores, right? 3 years was really, really good. Very, very strong profit. If you see the PAT here, right? Again, this revenue started to decline in COVID period 20, right? Again, 2023, it was not a COVID period, 362 crores only. So very, very choppy, very, very inconsistent top line as well as bottom line. In fact, in 2023, if you see, they were shying away from just making losses, from 200 crores sort of a profit to almost 1.41 crores of profit, about to make losses. And this cyclicity get reflected into the price of the stock as well. So I think these are some of the pulses you need to catch about any stock whenever you're doing analysis. Okay, so what are some good points about this company? So for that, let's dig deeper into the company's business model. So the company operates in MMR focused luxury real estate. So 2 words came there, MMR, which is Mumbai Metropolitan Region. Again, people who are living in Mumbai will know what is Mumbai Metropolitan Regions. You can see them here somewhere. And the second point is that they operate in the luxury segment. So going back to MMR has been in a big boom. 2024 MMR unprecedented land boom was reported in news. Again, there was a lot of land sold in Mumbai metropolitan regions. This has been possibly the second most booming area after NCR is what I can see. I've read a lot of reports about real estate and this is what I found. Second point about the luxury market, this company is operating in luxury segment. Uber luxury 39%, premium luxury 27%, aspirational luxury 34%. Now coming to luxury segment, there is a huge demand in India. I don't know how many people were following the news that in Gurgaon there was a Trump Tower that was launched, and the same very launch day, entire property, entire inventory was sold off. And I think if I remember the price point, it was 5 crore upwards. I think it was going up to 15 crores. So this is the kind of demand we are seeing in the luxury segment, and this company operates in that particular segment. Since it's a small cap stock, always look out for the debt to equity ratio, and also this is in construction sector. So more the reason for us to check out the debt to equity. What you will note very, very quickly is that the debt to equity has been coming down in the last 8 to 10 years, which is a very, very great track record. One of the positives of this company right now, in fact, this is a net cash positive company. They have zero debt, very, very very pristine position to be in as a construction company. Second good thing I see about this company is that if you look at their pre-sales number, which is that their sales before the construction is completed, that is soaring like anything. 32% growth is what we have seen. And in fact, if you look at the upcoming projects, so look at this orange color here, 4 projects are upcoming. These are all luxury projects and they will be upcoming. These are not yet sold. So looks like a good solid pipeline in the coming years. And if you look at the latest financial position of the company in FY25, they grew top line at around 51%, PAT at 112% as compared to FY24. What the management is saying in terms of the outlook is that FY26 is likely to see very similar growth. So I think the management seems to be very positive in terms of what is likely to happen in the next 1 to 2 years. If you look at the PE ratio, PB ratio of the company, you will find that the PE ratio is slightly more than the industry PE. PB ratio is lower than the industry PB, but if you look at the PEG ratio here, it is slightly on the higher side, 2.66. One of the negative points, because if you compare this company with likes of DLF, which is the PEG ratio is really low, which is 0.47. Low PEG ratio meaning the EPS growth is very high as compared to the PE, which is a very good thing to look at. Always go for stocks that have low PEG ratio. So potentially this could be considered as a negative point right now from a valuations perspective. So this was the 5 to 6 minutes of commentary on this particular stock. Please go and explore more real estate companies so that you can do some more peer comparison. With that, let's get to stock number 3. The third company that I want to speak about is a company called Cross Limited. This company is an auto ancillary company, and have a look at my screen. What you note is that in the last few months, Sudhir Rai, who is a promoter and director of the company, has been buying the stake at various price points that you can see in the month of December, February, May, and so on and so forth. Now, the reason I've picked up this stock for this discussion is that the company launched their IPO in September 2024. And what you note here is that the issue price was 240 rupees per share. It got listed at 240 rupees per share. And if you look at the demand of this company, it was oversubscribed by 17.66 times totally. And if you look at the qualified institutions, the demand was very high, 24 times over subscription. So there was a huge demand of this company's IPO back in September 2024. We are now in the month of May, or depending on when you are watching this video. One good news is the lock-in period for the anchor investors have expired, which was the 6 months. This is an extremely important point whenever you're investing in any IPO company, because typically what happens is that anchor investors will start to exit the company after the lock-in period, and this is where the stock prices sometimes take a dip, and you really need to be careful about this particular exit clause. Anyways, let me speak about some negatives and positives of this particular company. So if you look at the company's valuations right now, PE ratio slightly below the industry, PB ratio slightly below the industry. If you look at the PEG ratio of this company, it is 0.28. It is excellent PEG ratio if you compare this with peers, meaning that the EPS growth of the company is very high as compared to the PE ratio. This is a very strong figure if you compare that with peers. Now, what does this company actually do? So this company is an auto ancillary, as I talked about, and they manufacture components for trailers and tractors mainly. In fact, 44% of companies' revenue are coming from trailer axles and suspensions. So they are a niche player because they're manufacturing axles and suspensions for trailers. 8% from tractors, which is in the green here. Commercial vehicle components around 42%. Now, if you look at this company, up until FY24, they were growing at a very good growth rate in terms of the top line, from 297 crore to 488 to 620 crore. But FY25 has been a muted year for this company because they did almost similar flat revenue, 620 in FY24, 620 in FY25, because 3 quarters, quarter 1, quarter 2, quarter 3 of FY25, the company was struggling in terms of the demand. But what happened in Q4 FY25, if you look at the results, you will note that Q4 FY25 has been an excellent quarter for this company, 23% growth rate in revenues. If you look at the profit growth rate, again 26% growth rate in PAT as well. So very good momentum is what the company has built in Q4 FY25, which is January, February, March 2025. Now, what the management is saying is that January, February, March has been very healthy demand, a clear rebound for the company, and they expect this momentum to carry forward in FY26 as well. So management is sounding very positive in terms of FY26 as well. Now, in terms of capacity building and future growth rate, what the company is doing is they are going and building a new plant for seamless tubes at an investment of around 167 crores. Now, why are they doing it? Simply because they can use some of this, as you can read here, they can use some of this material in their excels, and this will be called backward integration. Some of it that they can't use, they will sell it off in the market. So they are essentially doing a backward integration plus some diversification, which is very, very good. So they are investing almost 167 crores. It is going to take them around 18 months of time frame. Second key point from expansion perspective is that the company is building an extrusion line. Again, if you're a mechanical engineer, you will understand this is going to enhance their capacity, and the commercial production is going to start from June 2025 onwards. This will upgrade their capacity of Excel beams from currently 5,000 units to 7,500 units. So a 50% up in the capacity. Always a good news when a company is expanding, because they possibly see healthy order demand coming up in the next 2 to 3 years. Is there any potential risk with this company? So what I see right now is that if we look at their revenue contribution, top 5 clients in FY24 were contributing around 66% of their revenue. In FY25, it has come down 59.3%, but still there is a concentration risk here, because if 59% of your revenues are coming from top 5 clients, there is a chance that if one of the client doesn't perform and if they stop giving orders, all of a sudden it might impact this company's revenue and profitability. But please also understand that this industry is very, very concentrated in itself, because we are talking about tractor manufacturing, trailer manufacturing. There are not like hundreds of clients here. The clients are going to be limited, but still top 5 clients are contributing around 59% of the revenue. It has come down slightly, which is a good news. But right now, I potentially see this as a concentration risk, because you don't know future if the orders start to come down. Because all of a sudden, if the orders start to slow down from even one client, that might materially impact the company's profitability and revenues. But I've given you the gist of this company. I would highly recommend that you go and look at this company slightly more deeper. You will find some good points, negative points, positive points, and accordingly you can decide what you want to do with this company. Again, all the 3 stocks that I've presented in this particular video, please do not take them as blind recommendations. Please make sure you do your thorough analysis. You do your own research before you taking any bets. In this video, I've talked a lot about these 3 stocks. Let me know in the comments which stock you think is looking very, very solid from a future growth perspective. Let me know in the comments. Would love to read your comments. Also, if you want to join my YouTube community, please go to my channel, find the join button and be my guest, because almost on a daily basis, I am posting some data backed analysis which will help you make better investing decisions. At least you will learn how to go about analyzing various assets. In a long term, you will become a very, very good investor. With that, I hope to see you in my next video. Until then, keep rocking.